Hello to everybody that will be joining for this webinar. Effectively, what we're doing is Tian and I are recording this one-on-one, and it's a follow-up from our China webinar that happened earlier in this week. There are a couple of good questions that came through on the actual webinar itself, and Tian and I thought it'd be nice just to kind of reiterate what those questions are. So Tian's going to run through the presentation again. Some of you might receive the recording from the Monday's edition, but we had a few technical problems, so we wanted to make sure that the actual presentation images that were shown and spoken to, that they actually reappear. So this is a bit of a catch up on what was done on Monday, but hopefully interactive enough between the two of us so that those of you that do receive it would enjoy the insights and the conversation that we'll have, particularly on what we all agree is a very topical geographical area at the moment, with some very interesting future opportunities, we believe, and particularly with Trump coming in as president-elect. What does that all mean for the future of investing in China? A number of us, you may be aware, recently visited China on an investor's trip, and we always enjoy taking people along with us to come and visit China and particularly see the sites and the companies and the activity that's going on. Importantly, everybody that walks away or comes back to South Africa from having visited China obviously has a very different impression of what things are like on the ground, which is very exciting. So what we try and do in this webinar or post-webinar event is just to relay some of that information again and show you insights into what's going on the ground and obviously from an economic perspective what we think may play out. Again, which I'd like to stress is very exciting and maybe very different from the views that you would hear from Western media. So Tian, thanks very much. I know it's dark and late night or early into the evening in Shanghai at the moment, so always a pleasure to have you, still at the office and joining us for this chat. Tian, maybe the way to do it, let's go through your presentation again. Let's let you and I sort of engage. I'll ask a few questions, maybe stop you along the way to re-emphasize or ask a different angle. But you head on and I will then interrupt you as we go.
Great, thanks, Murray. And hello to everyone that's watching this recording. And apologies again for our technical difficulties. Hopefully, this will more than make up for our difficulties that we had a couple of days ago. So just to run through our China webinar, I think this quarter is pretty much Trump 2.0 is the most topical issue on China. We obviously going through we are coming to Trump's second term. And as the slide suggests, we want to see if there's any major impact on China, Trump coming in for the second time. Right now, it's all about noise. We don't see anything complete yet, but I'm sure we'll be able to tell very, very soon. But just a bit of a recap to what happened during Trump 1.0. What we saw in 2017, 2018, China's rolling trade balance with a clear decline. Obviously, beginning even before the US fines to ZTE, Chinese telecoms giant, $1.2 billion that almost sank the company. Then we saw the trade war begin with crazy amounts of tariffs on a lot of Chinese goods, in total over $350 billion worth of goods at the time. And then US-China tech war, if everyone recalls, Huawei CFO being sort of stopped at the airport in Canada and then held for years before she was eventually let go. But with all of these issues hitting China's total trade balance, you can see how quickly China adjusted from 2019 to 2023. It was just one way up again. I've got a slide a little bit later, but China has certainly adjusted for this time, and Chinese economy is a lot more resilient and a lot more prepared for anything crazy that will come out of Trump's second term. And even during Trump 1.0, the trade recovered fairly quickly, although in 2020 and 2021, with a bit of help from COVID-related trade as the rest of the world shut off, while China was still open for a period of almost 2 years. If we look at the risks of Trump 2.0, very, very simple. There's been a lot of election talk about 60% tariffs on everything from China. There's been also talks about 20% tariffs on everything else globally. So the world will suffer, but China will probably suffer the most in terms of exports to the US. Perhaps there'll be more tech sanctions on Chinese firms. There are already a lot of tech sanctions on Chinese firms. And in terms of a political position from the US to China, we believe it'll begin at least with a more hostile political position to China. So if we look at Secretary of State nominee Marco Rubio, he's known to be a bit of a China hater, and he's actually on China's sanctioned individual list. So it's going to be interesting to see how the two countries interact after January 20th. If we look at the opportunities, also quite a lot. I mean, to the surprise of many, Trump was actually the preferred president over Harris or Biden-Harris. It would have just been a continuation of Democrat policies. The Chinese actually respect Trump's directness and his willingness to negotiate for a deal, and they believe there is potential for upside. And we believe the same. Both bilateral relations are going to be on ice for the foreseeable future, but with President Trump coming in, there may be some positive surprises. We believe there will be very little room to add more tariffs, even though the 60% tariffs will be talked about. US inflation is not really down to where it was pre-COVID, sort of, or even during COVID, where it was very low. Inflation will come through if tariffs are added on. There's very little room to add more tech sanctions. There's already almost 1,500 companies in China sanctioned by the US. Yeah, and I think the opportunity is probably for the odd deal here and there, but overall relations we expect still to be very challenging between China and the US. If we look at China's overall trade, this is to show how China's position for Trump 2.0. China's overall trade with the world, the gold bar is 2024 year to date. We can see that this year we're probably going to exceed 2023 again in terms of China's overall trade. Expected to exceed 40 trillion CNY, probably in the region of 43, 44 trillion CNY. If we look at China's total trade with the US, 2024 is also expected to surpass 2023. So even under IC relations, China-US total trade is still growing in absolute terms. What's more significant, however, is China-US trade as a percentage of China's total trade. You can see since 1999, it's just been one-way street down. Right now, China-US trade only about 1/10 of China's overall trade. And if we look at percentage of GDP, only if we look at just exports as a percentage of China's GDP, it's only about 3% of China's GDP. So even if the 60% tariffs are fully implemented, it only really directly impacts 3% of China's GDP. So we're in a much, much better position than we were in 2017. Yes, Mary.
So, yeah, just to jump in there. I mean, I think obviously Trump 1.0, I guess the Chinese economy understood what tariffs meant and started to pivot, and particularly around the Belt and Road strategy, meaning the other parts of the world, they would have picked up trade. And so as you've seen this fall here, it's not to say, look, the Chinese economy is suffering as a result of this, US tariffs, but effectively what they've done is they've been able to subsidize or pick up the residual from other places around the world.
Mm-hmm. Absolutely, yeah. I mean, if we look at this chart, so obviously if 1/10 is US, 90% of China's trade is with the rest of the world. So if China is able to grow that 90% by 10% per annum, just 1 year's growth will make up 9%, or make up almost the entirety of China-US trade. What it will impact on if China-US trade really suffers is GDP growth rather than a collapse of China's economy. So it's going to be painful nonetheless, but it's not going to be anything of a major impact, like you said. And China's been positioned for this since at least 2017, when they realized there's no way to negotiate their way out of it. They need to do something else to diversify, and diversify they've done.
I know the exports of EV vehicles to the US, with 100% sanctions on that. I mean, there's effectively no direct trade or sales of EVs into the US.
Yeah,
so,
I mean,
that's really not it's a moot point, effectively.
Yeah, absolutely. So, I mean, that was largely a publicity stunt by the Biden administration, in our view. Right now, there are pretty much no official channels of sales of Chinese vehicles into the US. There's some private imports here and there, but there's no volume. So, yes, you can say China probably loses a potential market in terms of future growth, but in terms of current sales, no impact on the Chinese EV sector.
Okay, thanks.
I'll carry on.
Yeah.
if we look at China's outlook for 2025, I think nice to revisit just why we believe China is such an important market. All of these circles on the slide are done in proportion to the size of the GDP. So you see South Africa, UK, India, the hottest market right now, and mainland China at 18.5 trillion. So you can see how much bigger China as an economy is relative to South Africa, UK, and India. The US is the largest economy in the world by nominal terms, but China is the largest economy in the world by purchasing power parity terms, and that accounts for actual purchasing power. We're literally chatting in the office this morning to have a salary of $100 in the US. You can literally have a salary of $50 in China or in Shanghai at least, and have a better lifestyle than what you would with double the pay in the US, just because how expensive things are there. And that's where PPP comes in. And but just on nominal terms, to give everyone an idea of how much China grows by every year, just 5% growth on the 18.5 trillion economy is almost $1 trillion a year. It's almost 3 times South Africa's GDP, just in pure growth every year. And that generates massive opportunities for investment into China. If we look at the stock market, it's the same thing. China is by far the second largest in the world. I mean, India, one of the hottest markets right now, is only about 1/4 of the size of the Chinese market. UK, about 1/5. South Africa, less than 1/10 of China's overall equity market. But what we're seeing in terms of global index weights is that China is just absolutely underweighted. So China has a lower weighting than the UK in the MSCI Equity Index. We believe it is massively underrepresented, given its size, both in terms of the markets and the economy. And we believe it's very important to have a more significant chunk of your allocation to China.
So Tian, on that, I mean, I think, the comments you would hear from other asset management businesses would say China's uninvestable. Now that I think is a comment made because either they haven't visited or spent the time looking at these companies. I mean, some of the challenges we get in having the same conversation is that there's been so much state-owned, percentage of a particular company because it's been sponsored by the state. But if you look in, certainly what we've experienced, but if you had to look through the size of that market and the number of companies that are listed, I mean, surely the point is, and we can just mention a few of the big names, there've got to be opportunities there. And as you say, as a component of the index, it's become a lot smaller. But surely from a long range opportunity for equity exposure, people have got to be looking at this and saying, well, the size of the economy, the size of the stock market, the advancement of the technology, the other industrial capabilities that they're generating, surely this is an investable market.
Yeah, absolutely. I think as South Africans, especially, right? So if we look at the Naspers investment in Tencent, it is probably the most successful private equity investment ever in human history. And that one counter example proves that China is investable over the long term. And we obviously believe it is massively investable. I mean, there are many fund managers that sit in London or New York or in a place that is not China, calling China uninvestable. And we understand that emotionally, China has been really a tough ride over the last 3.5 years, at least until September this year, where people have just been taking losses. And after a bear market this long, people often like to throw in the towel and just lose faith in a market. But given the valuations, given the long-term prospects of the economy, which will then eventually drive earnings and market returns, we believe it's just too big, too important a market to ignore. And it's just too underrepresented. Yeah.
Just again, from a South African investor perspective, saying, look, because of Reg 28, I mean, obviously we know the adjustment to go 45% offshore does allow you the ability, but there's another argument which says, I'm already invested significantly in an emerging market. But I think the growth dynamics, call it an emerging market, but the diversification that you're experiencing in that equity market is significant. And those are obviously companies that are selling product or components or whatever it is to other parts of the world. So it's not that it's just internal consumption. I mean, obviously, a lot of what China corporates are doing is building as I say, product or components and selling it to other manufacturers around the world. So, I mean, I guess that what I'm trying to get from you is to say, yes, it is an emerging market, but don't think it's the same extent of what a South African emerging market is.
Yeah, absolutely. I actually have a slide on this, and I'll jump to it actually.
Okay, yeah. We can always come back.
So it talks about sort of the sort of emerging market story, right? How China is not the same as emerging market, and we can show it in numbers. So for South African equity investors, JSE is obviously the main portion of your allocation. MSCI emerging markets is a very, very popular allocation, but the problem with MSCI emerging markets is it is an emerging market like South Africa, or it's an emerging market allocation to markets like South Africa. And unfortunately, it's got a really high correlation to the JSE, almost 90%. So you're not getting statistical diversification benefits from that allocation. Every other market in the world is actually a better diversified, or every other major market. If we look at China specifically, it's very different to a standard emerging market. It's got specifically China onshore, by the way. So I think we often talk about the two Chinese markets, China onshore and China offshore. We have capabilities in both, but we have a heavier weight towards China onshore. It's got only a 40% correlation to the JSE. So statistically, out of the major stock markets in the world, it's by far the best diversifier for South African investors. So if we look at this chart on the right-hand side here, it compares China onshore and offshore. China onshore is represented by the purple block, the blue purple block in CSI 300, and then the red block, pink/red block, is represented by MSCI China, which is what we term China offshore. So you can see on average, China onshore has got a much lower correlation to the JSE, whereas China onshore has a much higher correlation. That's why we believe China onshore is really a good allocation.
Just to be sure, for people that maybe don't appreciate that, it's China mainland A shares, and offshore is the Hong Kong shares listed in China exposure, but listed in Hong Kong.
Listed, yeah.
Okay. I did sort of pull you down the slide deck. Do you want to go back up and show some of the other slides you might have?
Go back up a little bit. It's some interesting slides. So I mean, we call China the irreplaceable factory of the world. We do that with backed by numbers. The simple numbers, actually, China makes up about 30% of global manufacturing GDP. If we look at the US, Germany, Japan, and India, US makes up 15%, Germany and Japan, major production powerhouses, only make up 5% each of global manufacturing GDP. India, 3%. So China alone makes up more than the US, Germany, Japan, and India combined in terms of manufacturing capability. And it's really, at least I don't believe in my lifetime, that situation is going to change. China is able to produce and able to transport the goods out. It's not just the production capabilities, it's the infrastructure that you need for the production, it's the supply chains that you need for the production, it's the port infrastructure and the transportation infrastructure that you need for all of the production. And that takes decades of planning ahead of time. We don't see any country coming anywhere close to China in the near future. I mean, the US industrial sector has been on decline. There's efforts to revive it, but I think it's going to be a massive challenge for the United States. And the next best comes in the form of Germany and Japan. They are 1/6 of China's capabilities, and we don't think it's going to catch up. So it's going to be really, really difficult. There's a lot of media noise on this, but practically it's impossible, at least for another couple of decades, for anything material to change on that front.
So
if we look at,
yeah, sorry, you speak about that and sentiment. I mean, and we go back to the market and the exposure. Is like the sentiment has been negative, and we know it's negative for various reasons, and it's obviously a West versus East thing, and we, certainly we've seen data which says that a lot of the propaganda, if you want to call it, against China is being pushed in the Western media, and that influences, I guess, everybody that sits outside of China's view on this market. So here you're seeing manufacturing capability, you're seeing company earnings looking strong. Obviously, these guys can export to different parts of the world. Doesn't have to be the extreme West, call it the US. So related to that, the sentiment in the country itself is very positive. And so we get this dichotomy between, kind of what the market reaction to everything is, and therefore share prices are low, versus the internal view that China's it's all good and hunky-dory. But then, maybe in answering that, talk to the property sector as well, because obviously that's a concern.
Yeah, so I think I do have some slides on sentiment, but essentially you're very much right. I mean, we've got a team here just filtering through media feed, especially in English media feed, and unfortunately, at least since about 2017, the entire English media narrative on China has been pretty negative. Obviously, prior in 2017, probably the Trump administration had something to do with it. And since about 2021, the poor market performance in China hasn't really helped. So essentially, the sort of mood of foreign investors on China, at least the investors that haven't visited China, has been pretty negative. So unfortunately, that is the case, and a lot of the time it creates a lot of blind spots for investors in terms of missing opportunities in China. So, for example, the September this year, when markets rallied 30% in a matter of 2 weeks, if you were not already in China then, you would have missed the rally. So these are the sort of big misses that one would miss if you just sort of discount China on general media noise, which is why we always warn against it. Murray, if you don't mind, I'll talk to property in the following section of the presentation. Sure. I'm just going to cover quite quickly sort of China's future expected tech dominance rather than current tech dominance. The US still dominates currently, but if you look at the patent applications and patent grants for 2023, you can see China absolutely dwarfing everybody else. And it's just a matter of time before sort of China becomes the global tech powerhouse, which is part of the reason why we believe the US is sanctioning Chinese tech companies really, really hard in terms of trying to keep its competitive advantage. The US Commerce Department doesn't even give reasons anymore in terms of applying sanctions to Chinese firms. So it's these numbers actually give us perspective on why there are so many sanctions on Chinese firms. But I think next section is probably, it'll talk to quite a lot of the things you mentioned earlier, Murray. I mean, we've gone through this correlation slide. If we carry on to the next slide, I just want to show what it means to have a low correlation market. So these are real life examples that happened this year. So August 2nd and August 5th in 2024, when the Japanese and Korean equity markets dropped 12.6 and 13% on over 2 trading days, China onshore was flat. It was down 92 basis points. So you want a market that moves independently of everything else around it. And China onshore is certainly a good market, representative of that. And then if you look at September 24th to 30th, the Chinese market can also rally independently. Onshore rallied 26%, China offshore rallied 16%, whereas the S&P 500 did 62 basis points over the same period. So it really adds to the diversification benefits in a portfolio. And I think this is a very important chart. If we look at cyclically adjusted, so CAPE stands for cyclically adjusted price to earnings ratios, China versus the US and India, you can see China, even after the recent rally, pretty much at all-time lows. Whereas if you look at the US and India, they are pretty much both at all-time high cyclically adjusted valuations. So it's really, we believe it's quite risky. India has actually sold off quite a bit as we speak over the last few weeks. China actually pretty stable. They've come off the early October highs, but for the year, it's still up about 16% year to date. We're actually having a good year in China, and there's still a lot of room for growth in China. So as at the end of October, China, in terms of valuation multiples, on a 66% discount to India and a 59% discount to the year. So you're buying similar type of earnings, but at a big discount. That's why we find China very much investable at this point in time. This is quite an interesting chart comparing NVIDIA This is as at the end of October. The number is probably higher as we speak now, but at end of October, Nvidia had a valuation of $3.3 trillion. That's almost 10 times South Africa's annual GDP. If we look at the Chinese tech sector, you have Tencent, Alibaba, and everybody else added together is 1.4 trillion. So just one single US company making up about 2.5 times the size of the entire Chinese tech sector. So, I mean, if I was holding NVIDIA, I would sell half my NVIDIA and buy the entire Chinese tech sector. I think it'll do me better over the long run.
So, Tian, on that, I mean, I guess from a stock selection point of view, your process being a systematic process as well, looking at different factors. I mean, within that composite of tech companies in China, there's some really good companies that have strong earnings, have been, they've got dominance in their market. I mean, these are really good companies, I mean, that's obviously the exposure that people should be getting. So the question here is, how do they get exposure to this through the funds that, the Prescient China team manage?
Yeah, absolutely. I think we obviously try and pick the best of the industry, and our track record obviously speaks for itself. So, I mean, for us, it's very, very simple. We've got our Prescient China Balance Fund. The balance name is a bit misleading, but we've had the fund since 2013. It's probably got the strongest China track record out of most China fund managers out there. We rank over the long term consistently top 5 percentile globally across peers. So in that product, we give investors it's from South Africa. We've got a Rand feeder fund version. We do everything for you. We pick the stocks. We do asset allocation. When stocks are expensive, we do more fixed income and bonds. When tech is cheap, like right now, we are overweighted China tech. When tech is expensive, like they were back in 2020, 2021, we were underweight China tech. So all of these things pretty much just, I can call it in simple terms, just close your eyes and buy the Prescient China Balance Fund, and all your sort of China investment needs will be sorted. It's designed to be an all-in-one China solution. China is not a major asset allocation for South African investors, so we never expected South African investors to have a China asset allocation capability. That's why we built everything into one product. That guys can just buy, investors can just buy and have peace of mind that everything China is taken care of for them.
I think you do show sort of the composition of, or the allocation of China in the emerging markets index, which has come down substantially over the last while. So, I mean, yeah, go for it.
Yeah, so I mean, obviously, firstly, in terms of, for example, the MSCI Emerging Markets Index, there's all the MSCI indices have inclusion rules for Chinese equities, which naturally already make Chinese equities lower than what they should be, at least in our view, in terms of the weighting index. And obviously, I think since 2021, Chinese equity markets, if you add onshore and offshore together, on average, it's halved. So just the decline in the market has driven that down weighting as well, purely by market movement. But as the market rallies up, the weighting in the indices will increase as we go along. So, and this year is probably the beginning of a sustained rally. We are seeing a lot of positive policies come through from government, which I will cover in a few slides' time. But overall, yeah, I mean, it's just absolutely on sale. And things are looking much, much better than where we were a year ago.
Okay, thank you.
Okay, I'm going to go on the slide, and that takes us to sort of the latest news. Economic data, pretty mixed, but largely positive, actually. So if we look at CPI is a bit of a worry. It's hovering around the 0 mark. We wanting CPI sort of between the 1 to 2% mark. And with a lot of consumption data coming through, so for example, retail sales growing better than expected in October at 4.8%, we expect CPI to slowly get better. So that's sort of on the positive outlook. PPI, unfortunately, is still negative, but PPI and CPI typically aren't necessarily linked and move in sync. So PPI not as largely negative as before, as we've seen double-digit negative PPI before. So we're in an okayish space in terms of CPI and PPI for now. Exports doing exceptionally well, up 12.7% in October, much better than September's 2.4%. And home prices, the property sector mentioned earlier, that's going to be a consistent drag. I think we've been bearish on the property market in China since 2018. We were probably 3 years too early to that. But right now, we expect the property sector to be in the managed decline scenario where government releases supportive policies, not for the revival, but for the stability of the sector. We've seen a lot of debt swaps go through. And on the next slide, I think I do have monetary policy. So if we look at the monetary support, one of the things, if we look at this one, the central bank pushed through 300 billion CNY of purchasing unsold properties. So just purely purchasing unsold properties in the sector, and that's 100% allocated to the property sector.
Sorry, can I ask you sorry to stop you there, just on that. I mean, from a Chinese individual owning their personal property, I mean, and having been there and spoken to you about this, but I think it's an important one to sort of just give people an appreciation, if they don't already have it, as to where the property issues are. So we talk about tier 1 and tier 2 cities, but you're not sitting in Shanghai in your property fearing that this thing is going to go to naught. I mean, the cost of properties in Shanghai and Beijing and tier 1 cities is expensive. That's not where the problems are. They're way further out. And largely, while, yes, there's a debt overhang, but were those not somewhat engineered? So there was a massive push to grow the property market, which meant you had imports, steel, cement, labor. There was a very clearly designed reason for all of that. But now, I mean, I think the difference is you're not feeling concerned about your property valuation, I don't think, in Shanghai. Maybe just sort of give a broader sense of that property issue.
Yeah, absolutely. So, I mean, in tier 1 cities like Shanghai, properties can literally be, I wouldn't say 100 times, but 50 times the price of the equivalent property in a tier 3, tier 4 city. So, like you said, Murray, if the properties collapse in tier 1 cities, that would be a big problem for the economy. Whereas property collapses are probably in your tier 3, tier 4 cities, largely because there's limited organic demand and there's ample supply. And a lot of local governments, why there's ample supply is local governments in tier 3, tier 4 cities never had good economic industries to begin with. And selling land to property developers was a good revenue generator. So when the national property boom was on, the local governments just sold land to property developers to build more and more properties. But those tier 3, tier 4 cities had net decline in population because the younger generations moved into tier 1 and tier 2 cities for economic opportunities. So you sort of in a vicious cycle, there's more property, but there's consistently less demand. And as the property bubble burst, those are naturally the first cities to burst. But the good news is that on an overall level, the percentage of the property market of the massive amounts of property in tier 3, tier 4 cities, which is where you see the ghost cities, for example, they look terrible visually, but in terms of affecting the entire financial system and the economy, the impact is quite limited. The reason why properties in tier 1 cities are so expensive is that supply is very tightly controlled. But then you literally have demand from everybody in China because cities like Shanghai and Beijing attract people from all over China, the young population to come through and seek for job opportunities, etc., with their entire family supporting them for property purchases. So it's a very different dynamic, whether you're in tier 1 or in a tier 3, tier 4 city. But overall, tier 1 cities are very stable in terms of the primary market for property. Secondary markets have come down a bit, but it's normal market movements rather than absolute collapse like tier 3, tier 4 cities.
And then if you go, sorry, what was striking was that retail sales is strong. So the internal consumption rate of goods is still well supported. It's not like the internal economy is collapsing.
Yeah, absolutely not. I think Chinese people are very good at saving money And when they are uncertain about economic future, they choose to save rather than spend. So if you look at savings data in China, there's about $20 trillion of savings last I checked. So $20 trillion is slowly growing, making all-time highs because people have cash, but they aren't willing to spend until they are more certain about economic future. In October, it looks like people were more willing to spend compared to a year ago. In November, we have the Double 11 Consumption Festival. So when retail sales come out in November, we expect to see a good number again. And there's been quite a lot of, at local government level, quite a lot of supportive policies with consumption vouchers, etc. So all of these help. And with confidence coming back, it just literally takes something random as the sort of when we look back at historical events, something random can be a trigger for an entire sentiment change in Chinese consumption and in Chinese equity markets. And that's what we're waiting for.
Sorry, just I know you and I both seen a graphic from a different analyst group, and they show the support of the banks lending into the retail market. While obviously that has come off, it's gone into the industrial space now in quite a substantial way. So you've had this shifting of where support has been. And obviously the industrialization and the reform that's going on is, to your point around, I guess, whether it's in the, some level of industrial or tech sector, is there's still a lot of money that gets moved to a different category to boost and support that economy or that part of the economy.
Yeah, absolutely. I think one of the reasons why the Chinese property sector has not been revived is that there's a clear directive from the government not to throw good money after bad projects, and reviving the property bubble is the last thing they want to do. So they've encouraged banks to lend to productive economic sectors, to SMEs, to the semiconductor sector. The semiconductor sector is arguable, but it's very much more on that tech self-reliance drive rather than profitability. In the EV sector, for example, that's very profitable in the renewable energy sector. So there's massive amounts of funding available. There's no lack of liquidity. And obviously, we saw on this slide, there's a massive sort of support on the monetary side to ensure there's enough liquidity in the market for physical businesses and for financial market participants. If we look at fiscal support, I think I'm just going to carry on with the slide as I'm answering this question, Maria, is that we are seeing more and more money being allocated. So the big number here is Housing Ministry adding an additional 1.8 trillion to help stabilize. But if you think 1.8 trillion is big, the MPC announced 10 trillion CNY of debt packages just a couple of weeks ago to support the entire economy in terms of domestic government level. So central government is going to do debt swaps with local governments so that they can take money and invest in the local economy. And part of that 10 trillion will probably eventually find its way back into the property sector, but the majority of it will go to more productive sectors of the economy if things are done right. And there's a lot of oversight on these funds going forward. Okay, I'm going to carry on. Just PMI data, as per usual, we've been hovering around 50. Now, both numbers in terms of services and manufacturing PMI from the private sector survey and the official survey above 50. If we look at retail spending over October, the China Mid-Autumn Festival and the National Day holidays, both are fairly positive. So we're quite looking like we are getting back to pre-COVID levels of confidence. I think another couple of quarters and we should see much, much better data. If we look at moving on to Prescient positioning, I think we cover obviously our balance fund. And I think one of the things we want to communicate to our clients is that, and I'm sure they would have experienced, and there may be some potential clients on this watching this video, is that the Prescient China experience is not the same as your average Chinese market experience because we do a lot of active management. So for example, this line chart shows our active equity exposure. Earlier in the year, we were around the 65% mark. Middle of the year, when the markets rallied a bit, we were close to 97. Then when markets lost steam, we very, very much quickly actively cut on exposure to around 80%. But because valuation was very, very attractive, we didn't cut lower. And as the markets recovered, we slowly began allocating exposure. Right now, we are about 90% equity exposure with 20%, 26% of that 90% protected because that relates to the tech sector. And we like to add protection onto because the China offshore portion, where the tech sector is based, is very volatile, with foreign investor sentiment quite volatile on the Chinese markets.
So Tian, just to ask, when you in that previous slide, when you're at your highest weight and you want to take it down, do you sell the equity or do you just put protection on? So kind of put a floor in place and then lift it later to get the exposure up again. And if that is the case, does it go into the fixed income bucket as you're showing?
Yeah, so I mean, we could make use of a range of tools. So depending on what's more efficient and how quickly we need to act, sometimes we may reduce exposure synthetically by using option structures. Other times we may just sell our equities. We ensure that our equities are extremely liquid. We typically can liquidate or buy our entire portfolio within a day without affecting market pricing. So right now, the protected equity is quite solid. So in terms of the unprotected equities, we have probably half. So when we move, we probably use half derivatives, half physical equities.
And I recall you saying that those trading costs are minuscule. So
yes,
very efficient to trade.
I'm not sure if I'm allowed to publicly share our brokerage fees, but they are absolutely low. I don't know. Is it something like, I wouldn't say, I would say at least maybe not 1/10 of average brokerage rates in South Africa, but certainly a massive discount, maybe like a 70-80% discount to what institutional guys are used to getting in South Africa.
Yeah, and sorry, I know I'm harping on this, but I think it's important because people think, obviously there's a sort of conspiracy component. Like, am I going to get my money back? And is this thing going to trade? But to your point, you're trading in deep liquid equity markets. And these are the largest stocks that trade anyway in the CSI 300. It's not like you're trading deep down in small mid caps that have no volume and you're going to get stuck.
Absolutely. Yeah, I mean, we run obviously a South African feeder fund unit trust structure that offers daily liquidity. So people can buy and sell on a daily basis. Our Irish UCITS structure also offers daily liquidity, and our mandate is managed to ensure that we can liquidate everything within a day. So we are very, very strict on liquidity and risk control in terms of accessing assets that we are sure we can liquidly trade in a very liquid manner on the markets. Cool. I'm going to move on. This is a bit of a boring chart, total performance. I'm going to skip this, but I want to show how we've done in terms of balance fund versus the CSI 300 nominal index year to date. So you can see when markets are slightly down, we tend to sort of do better than the markets. We tend to drop less, and then when markets are up, we try and keep up with the market at least. So this year we've actually managed to beat 100% equities on the upside. On a nominal basis, on total return basis, we've kept up, and on the downside, we managed to protect. So it just shows how successful our active asset allocation can be in our Prescient China Balanced. So in terms of our long-term consistent performance, this green line is the MSCI Emerging Markets Index. Then we have the MSCI China Index, and the gold line with the CSI 300 Index. And since our inception, net of fees, the Prescient China Balanced Fund has outperformed MSCI Emerging Markets total return by 82%, outperformed MSCI China total return by 82%, and outperformed CSI 300 total return by 53%. So you can see this chart is more to illustrate consistency of our asset allocation process in generating alpha. Even though we're not benchmarked towards 100% equity indices, our benchmark is CPI plus 3, China CPI plus 3, and we significantly beat that over the long term. Morningstar ratings were all very, very solid. And in terms of this presentation, I think the last thing I wanted to introduce everyone to is our Prescient China Gear Alternative Investment Fund. So it's our hedge fund that's also Section 65 registered for distribution in South Africa. It's just for those clients that want a smoother ride in China, that have really downside risk control. So the red line is our Prescient China gear, the blue line is our Prescient China balance. You can see that over a down and up cycle, the returns are very similar, but just on the downsides, on the downs, the Prescient China gear is a lot smoother. The downside from Prescient China gear is that we don't offer RAND access, we only offer dollar access, and it's only a monthly traded fund. So we don't offer daily liquidity on the fund. So that's sort of the differences, but it is an option for guys to consider if a smoother ride in China is what they are interested in. And I think that's it. In terms of looking forward, I think we are right now, I'm going to skip all of these. We are at sort of the green circle. We only a little bit of a rally from an absolute bottom. And you can see the previous rallies in China, there's really been big ups. And we are quite certain that the next big up is going to be in the next cycle. I think that's it. Oh, well, I have one more slide actually. The Trump 1.0 was actually very good for Chinese equities. Throughout Trump's last term, Chinese A-shares were up 81%. So Trump is not necessarily bad for Chinese equity markets. Maybe bad for tariffs, but pretty good for Chinese equities.
Is that China in the heading there meant to be with an American accent?
Not an American, but in a Trump accent, like China.
Thanks, Tian. Look, I think the big point here is that, we certainly, I think the comment is it is investable. You have to be discerning about the stocks that you want to get involved in a portfolio, strong earnings, liquidity, all of those good aspects. But I think the big question is, this downward slump that you've had is not based on poor economics, but certainly politics and tariffs. But the big thing is the sentiment shift. Like, what is that little one element that makes this trigger off? Because we've seen how quickly, there can be a spurt up in the equity markets in China, and you want to be there. So, there's what is that catalyst? One question. The other one is undoubtedly, for those that believe in the long-range story of what China is trying to engineer here, there is certainly an argument to be made for being involved in a market that is somewhat investable.
Yeah, I think certainly to your second question of long-term investing into China, I think that's what the market, not the market, that's what the regulators want China to change to. If we look at this slide, right, you can see China is just big ups and big ups and downs. And if you don't catch China on the big way up, chances are you lose money for a long time before you make money back through the next cycle. And I think for long-term investors in China, it's certainly good news that the regulators want China to be a more sustained upward growth market over the long term rather than big ups and downs. And I think early October this year, the disappointing sort of stimulus announcements were actually intentional because we had rallied 30% over 2 weeks. If that carries on, there's bound to be a bust after the boom. So I think it was executed pretty poorly in our view in terms of the intentions by the regulators, but we see what they're trying to do. They want to cool things down so that this year we have 20%, next year we can have another 20%, then another 20%, so that the market doesn't go up 80% down, then next year we have a down 30% year, which then doesn't help China's long-term image as an investable or long-term investable market. In terms of catalyst for the rally, we believe, certainly we expect some more stimulus policies to come through after January 20th. We do understand that the NPC here, the regulators and central government want to see the initial Trump policies towards China before they act on something. It gives them a more of a targeted approach. What we probably cannot say is other random sort of catalysts. If we look back at historical rallies, Chinese equity rallies have always been triggered by something random. But everything that needs to be in place is in place. Policies are supportive, valuations are very cheap. Sentiment is probably right now neutral. We just need sentiment to turn, and sentiment is something random. And it could be just a good bunch of consumption numbers that come out for Chinese New Year in late January next year, which will be released in February/March. And then March also coincides with the MPC meeting next year, where central government announces more policy. So March could be an interesting time to watch. We're certainly going to watch it very, very closely. But we have a lot going for the potential of a nice sustained rally here in China.
Stuff. Tian, thanks very much. I appreciate you spending time again going through all of this. I mean, very exciting market. But yeah, thanks again for delving into it. We'll obviously share this recording with people that weren't able to make the previous one or missed out on the slides. So again, thanks for the time. And now you can pack up and go home. It's starting to get a bit later in the evening there.
Great. Thanks, Murray. It's hopefully, yeah.
Good stuff. We'll chat again soon.
Okay, cheers.
Thanks, Tian. Cheers, everyone. Bye.